Ever pondered how reliable the advice of financial YouTubers truly is? In recent times, we've witnessed an exponential rise in the popularity of financial YouTubers. They've become the go-to source for many seeking advice on investments, savings, and financial independence. But here's the catch. The glittering world of financial YouTubing isn't as shiny as it seems. The potential risks of blindly following their advice are manifold. While it's true that some of these YouTubers offer valuable insights, many others are just regurgitating information available freely on the internet, with no formal financial education to back their claims. Imagine this. Would you trust a doctor who acquired their medical knowledge from Google? Probably not. So why would you trust a financial YouTuber who might have done the same with finance? So, is it really safe to bet your hard-earned money on the advice of someone who might have learned finance from Google? Now let's dive into a comparison of advice given by different financial YouTubers. If you've spent any time on YouTube's Finance Corner, you've likely come across a wide variety of voices, each with their own unique take on managing money. While diversity in opinion can be enriching, it can also lead to confusion and indecision, especially when it comes to your hard-earned cash. Take, for instance, YouTuber A. He's all about the slow and steady approach, advocating for index funds and a long-term investment horizon. He's the tortoise in our financial fable, if you will, preaching patience and consistency. His risk tolerance is low, and he's a firm believer in the saying, "Rome wasn't built in a day." On the other end of the spectrum, we have YouTuber B, the hair of our tail. She's a day trader jumping in and out of the market chasing the next big gain. Her risk tolerance is high and her advice reflects this. She's all about quick wins and capitalizing on market trends. Then there's YouTuber C, who falls somewhere in between. He's an advocate for a balanced portfolio, mixing long-term investments with short-term opportunities. His risk tolerance is moderate, and his advice is a blend of the methods employed by both YouTuber A and B. Now, imagine being a novice investor, trying to wade through this sea of conflicting advice. It's like trying to navigate through a maze with 3 different maps, each leading you in a different direction. You might be tempted to follow YouTuber B's advice because, let's face it, who wouldn't want to make quick money? But then, you hear YouTuber A's advice about the long-term benefits of investing in index funds, and start second-guessing yourself. And before you know it, YouTuber C comes along with his balanced approach, leaving you more confused than ever. This is the problem with having too many cooks in the kitchen, or in this case, too many financial gurus on YouTube. It's like trying to follow a recipe when everyone is shouting different instructions at you. You'll likely end up with a dish that's too salty, too sweet, or just plain unpalatable. And the stakes here are much higher. We're not talking about a ruined dinner, but potentially your financial future. Following the wrong advice, or employing a strategy that doesn't align with your financial goals and risk tolerance can lead to poor financial decisions. So what's the solution? Well, it's not about choosing one YouTuber over the other, but rather understanding that each person's financial journey is unique. What works for one person might not work for you, and vice versa. It's about taking the time to understand your financial goals, risk tolerance, and investment strategy, and then finding the advice that aligns with your unique situation. As you can see, the advice of financial YouTubers is not uniform and can often be conflicting. This makes it hard to decide whose advice to follow. While there may be some gems of wisdom, there are also some serious drawbacks to following financial YouTubers. Let's start with the elephant in the room: education. Not all financial YouTubers have a background in finance or economics. Some may have learned their trade from books, courses, or personal experience, which can be valuable. But it's not the same as having a formal education. This lack of formal training can lead to misinformation, as they may not fully understand the complexities of the financial world. It's not uncommon to see a YouTuber oversimplify a complex financial concept, which could lead to misunderstandings and potentially costly mistakes. Then, there's the issue of bias. Every YouTuber has their own investment preferences and strategies. Some may lean towards real estate, others might favor stocks or cryptocurrencies. While there's nothing inherently wrong about having a preferred investment type, the problem arises when they overly emphasize their favorites, potentially influencing their viewers to make unbalanced investment decisions. Remember, what works for one person may not work for everyone else. It's crucial to have a diversified portfolio that suits your own financial goals and risk tolerance. Lastly, we need to talk about the promotional aspect. Some YouTubers may be incentivized to promote certain financial products or services, either through sponsorships or affiliate partnerships. While it's perfectly fine to earn a living, The issue arises when the promotion of these products isn't clearly disclosed, or when the YouTuber's financial advice is influenced by these partnerships. This can lead to viewers making financial decisions based on biased advice, which could have serious ramifications. In conclusion, while financial YouTubers can provide valuable insights and help demystify the world of finance, it's essential to approach their advice with a healthy dose of skepticism. Be sure to do your own research, consult with a professional if needed, and make financial decisions that align with your own personal goals and circumstances. The potential downsides of following financial YouTubers far outweigh the potential benefits. So, should you stop watching financial YouTubers altogether? That's the million-dollar question. Well, not literally, but you get the point. Let's take a step back. The world of finance is complex. It's a labyrinth of numbers, graphs, and jargon that can seem overwhelming. Financial YouTubers in their own way try to simplify this world for us. They provide opinions, insights, and sometimes predictions. But that's just it, they're opinions, not facts. It's essential to remember that. When you watch these videos, it's easy to get swept up in the confidence and charisma of the presenter. But remember, they are not financial advisors. They are not responsible for your financial decisions. They are entertainers. In the world of finance, there are no guarantees. What worked for one person may not work for you. Every individual's financial situation is unique, and what seems like a good investment to one person may be a terrible one for another. Every piece of advice, every prediction, every tip should be taken with a grain of salt. It's important to do your own research. Dig deeper. Look at the facts and figures yourself. Understand what you're investing in. Know the risks involved. This is where financial advisors come in. They are trained professionals who take into account your financial situation, your goals, and your risk tolerance. They provide personalized advice based on these factors. They are regulated by law, and they have a fiduciary duty towards you. This means they are obligated to act in your best interest. So, should you stop watching financial YouTubers? Not necessarily. They can provide valuable insights and a different perspective. They can simplify complex financial concepts. But remember, their advice is not gospel. It's a starting point, a stepping stone. It's up to you to take it further. Remember, no one cares more about your money than you do. So be smart and do your own research. In conclusion, while financial YouTubers can provide some useful insights, they should not be your sole source of financial advice. In this journey, we've taken a deep dive into the credibility of financial YouTubers, comparing their advice and examining the potential downsides. It's clear that while some creators offer valuable perspectives, there's a wide spectrum of quality and reliability. We've seen how the lack of standardization, the pressure to generate views, and the temptation to oversimplify complex financial concepts can distort the advice provided. It's important to remember that these creators are not necessarily financial professionals. Their advice is often based on their personal experiences, which may not be applicable to your own financial situation. We've also highlighted the potential risks of relying solely on financial YouTubers for your investment decisions. The risk of misinformation, the potential for conflicts of interest, and the danger of one-size-fits-all advice can lead you down a rocky financial path. But it's not all doom and gloom. Financial YouTubers can be a great starting point for learning about finance and investment. They can make complex topics more accessible and provide a wealth of information at your fingertips. However, the key takeaway here is the importance of doing your own research and consulting with a financial advisor. A financial advisor can provide personalized advice that takes into account your financial goals, risk tolerance, and current financial situation. They can guide you on the path to financial success, helping you avoid potential pitfalls and seize opportunities. Remember, finance is not a game. It's your future, it's your security, it's your peace of mind, and it deserves careful consideration and thoughtful decision-making. In the world of finance, there are no shortcuts, so take your time, do your research, and make informed decisions. Your wallet will thank you.